So it's good to be back here with you all, and just again, really providing an overview of the planned investment options, as Tony mentioned. Fees always, again, this is your plan. We endeavor to be just very transparent about the entire plan. So just giving you some insight there. And if you have questions, certainly now would be a great time to sort of interact in that particular discussion. And I'll just say that broadly, if any of you all have questions or things you want me to pause on, then please let me know. The material I'm covering today should be, probably about 50, maybe 20 to 30 minutes, but we can certainly pause to walk through anything that would be helpful to you. So I'm going to share my screen here, and if somebody, maybe Kirk, I can see you, I can't see anyone else. Maybe give me a thumbs up if you can see this okay. Can you see the share? Okay, getting some thumbs up there. Perfect. All right, thank you. Let me expand this out so that a little better visual. Okay, perfect. There we go. That should be sufficient. Moving forward, again, real quick reminder: plan investments, understanding fees, just broadly. How should we be thinking about fees, both for the city's plan, and then there's probably some more applicability to this in your personal life, either if you have individual IRAs, individual accounts, or you've had a previous employer with a retirement plan. Is pretty broadly applies to all. And then we're going to look detail into the city's fee structure and how that is going to impact you. Finally, the Vanguard Target Retirement Funds investment approach. Really wanted to give a sort of a primer and a reminder on what those investments are. They've been really impactful, I think, for participants that have used them to be investment tools as they plan out retirement and sort of invest over a long time frame. They're very dynamic, and wanted to just give some insight so you have a better understanding there. And of course, answer any questions or have discussion around them. First of all, let's take a look at the investments in your plan. And just as a maybe thinking about all of the investments in your plan, I'm sure if you brought them up on your Now Empower website, you would see a lot of different investment options. We tend to think of them in two different buckets. There's the ones I'm showing you here. You can see that we're calling it the core investment options. The do-it-yourself. This is where an individual might want to build their own custom portfolio, right? You may be, want to build your investments in a particular way, whether that be more aggressive, more conservative, somewhere in the middle. And this investment lineup, or this core lineup, as we're calling it, gives you a broad coverage across various investment categories. And just to run through a few of them, you can see the larger categorization on the far left here, where it says fixed income, large cap, small cap. Those are just broad categories, right? So fixed income, another term for bonds, tend to be a little bit more conservative, something that you might use if you're trying to, sort of eliminate market volatility, or you're preparing for sort of a cash stream at some point. You want to protect the movements up and down. So in that bond or fixed income category, there's a few different types of bond investment options, from more conservative, that Putnam stable value, that's cash preservation, all the way to global bonds, right? So those all have different stripes of a fixed income or a bond fund, and they each have their own risk return characteristics. You move down to the next line here where it says large cap, and I'll talk about mid cap and small cap too. Those are U.S. stocks, and starting with large cap, those are large companies. Probably the most notable would be the S&P 500 index. So you can see that as a second option there, and that's just a fund that invests in the largest 500 companies in the United States that are publicly traded. There are other large cap, U.S. stocks that are value oriented, that are growth oriented. So again, a little bit different risk return characteristics. Same things exists in the companies that are categorized as mid cap. So again, just that next tier down. So a lot of mid cap stocks and then small cap as well. And finally, international stocks again are going to look and act somewhat similar to the U.S. stocks, but they have their own impacts and things that are going to drive how they move. And what would generally see is somebody might look at these investment options and again utilize a variety of them to build an investment lineup that's appropriate for them. You may have an external advisor that's using that. You may have the tools and knowledge yourself. I will note that with the Empower tools, you all just moved your plan from Nationwide to Empower. They do have a resource on their website that allows you to get a layout of a potential asset allocation or just mix of funds that might be appropriate for you. So that is available to you if you're looking for some sort of tool there. I also one other item I want to note is, and this is going to be something I'll reference as we move through this presentation. Similar to Nationwide, Empower has a service that are called managed accounts. The term that's used or that you'll see in the Empower website is called My Total Retirement. It was branded as something different at Nationwide, but at Empower it's called My Total Retirement. It's essentially a service that you can opt into. There's a fee for it, and I'll run through that later, and the fee applies to the individual. But you can run through a questionnaire. It asks you questions about your age and those sorts of things. You can add in other investment accounts if you have them, and it's going to, in theory, kind of incorporate all of that and then build an investment allocation that's appropriate for your whatever time frame you have or whatever your particular situation might be. And so that's another tool that can be utilized. Again, this has been available with Nationwide as well. It's available with Empower. There's a pretty significant cost to it. So from a consideration standpoint, you would definitely want to think about that before utilizing it. And that also, again, in contrast to some of the tools that are already available in the plan to help you have a investment that's appropriate for your time frame and to manage your risk over time. So that's the goal of the managed accounts. There is an investment option built in the plan that you can elect that already has those sorts of features. And this is that second section of the investment lineup. They're called retirement target retirement funds, or what we call it, the do it for me category. And you can see there's a variety of vintages here from 2020, which we're 5 years beyond, and I'll explain that later on in the discussion, all the way up to 2070. So the way somebody might utilize this is say, well, my retirement date, or when I'm 65, I'm planning to retire, and that aligns with the year 2050. So I'm going to elect this target date 2050. And that investment is structured in such a way so that it's age appropriate. It has a mix of stocks and bonds and all of those investments that you would try to put together yourself that are targeted for somebody to retire around that age 2050. So today in 2026, it's going to be a little bit more aggressive than it will say in 2036 and in 2046. They're dynamic and they change over time, right? So it has that component of portfolio management for you. They're extremely low cost relative to other investments that are available in the managed account service. And for a lot of individuals, that's been a really good tool. So we'll talk a bit more about that, but I wanted to just break this down and set the stage first, giving you an overview of the investment options, the do it yourself, the do it for me, and then also note that managed account service where they would use those do it yourself options. Okay, before I jump into fees, questions or comments on any of that? I know it's pretty broad, but not a ton of detail, but hopefully that helps. Okay, so let's talk about just overall plan fees and structure, for any retirement plan, you think about the components that are involved, and there's some sort of record keeping base, right? You have Empower Nationwide, who are providing a service for allowing you to access a website, track your data, service the city in tracking all of these accounts, allowing dollars to be contributed in, distributions to happen. So any retirement plan that you have, or again, I would say applicable to an individual account as well, you're going to have some level of administrative fee. And that doesn't include transaction fees. If you take a loan or something like that, there might be individual sort of transaction fees that you are faced with as an individual for actions that you take. But just broadly across the plan, there's an administrative cost. And again, we'll look at some detail here. The other cost to think about is our investment fees. And I guess to go back, the administrative fee, that's going to be an explicit cost that you'll see on your statement. You'll see that as a negative cost on, or a negative sort of value on your statement. Any of us have that in our retirement accounts. The other fee is the investment fee. So all of the various investments you have, and I kind of outline the different expense ratios or the costs. These target date funds are 0.065%. The do-it-yourself costs range from 0.012% to 0.97%, right? So it's a range depending on the type of investment. But those investment fees are also a cost that you bear as a participant. And you won't see that as a line item on your statement. The way that those come out is that they're net of fee, or they're net of your performance that you receive. And but they're important, right? It is a fee that we all pay for holding investment options. From a committee standpoint, and us serving the committee as a fiduciary, our goal is to minimize those investment fees as much as we can, right? Reduce that headwind as much as possible. And they've done a really, really good job at it. And so we'll again, kind of go into some detail there, but just broadly thinking, I know kind of big picture, administrative fees, something that you're going to experience in your own account. Investment fees, you'll experience some of them well, but you won't see them because they're net of performance is net of those fees. If you do have that My Total Retirement service, if that's something that you've signed up for and you utilize that, you're going to see an additional cost in your account. So that's your total costs are going to be the administrative, the investment, and the My Total Retirement fee. And I think this is important to distinguish so that if you do choose that service, understand that there still is a fee for the underlying investments that you hold. The My Total Retirement, or that managed account service, it does allocate your portfolio based on your inputs into the system. However, it allocates it using the investments that are already in the plan, that are in that do it for me or do it yourself section. And so you will also bear the cost of those underlying investments. Questions there? Okay, a little bit more.
Hey, Ted, Ted.
Oh, go
ahead.
We
had a couple of people raise their hands, Kirk and Poe, and then also Sebastian asked if we could share the slides afterwards.
Sure. Yeah, it's okay with me.
Okay. Kirk, yeah, you had a question?
Yeah, why don't we go?
Yeah, where when you go on to the Empower site, do you see you verify the target retirement investments? Where would you find that in there?
The target retirements?
Yeah.
I guess I'd have to.
They should be under the investments section. So they are treated as any of the other standalone investments in the plan. They're just ordered and grouped together, I believe, at the top of the stack.
I guess, how does it know what year you're looking then? Or is there somewhere you go in there and verify what year, the target year?
Well,
so
that would,
sorry,
go ahead, Anthony.
I was going to say, if you make no choice, it bases it on the year you turn 65.
Okay.
So we have
or closest to that. If you do make a choice, you could choose something more aggressive or more conservative than the default choice.
Okay, and you could adjust that default choice, I take it?
Yeah, so once the default is on day one when we set you up over there, it'll pick your year. You can choose something different at any time.
Okay, and you find that in what area then? That would just be your investment
under the
section?
investments. Yeah, under the investments, where you can either transfer money between funds or set up where your new money is going. So two different ways to look at your money, where your new money is going or transfer funds into that investment.
Okay.
And then Poe, you had a question?
I do. So I know we transferring from Nationwide to Empower. So how is that fund allocated? Are they transfer similar or the same from Nationwide to Empower? That was
exactly
invested.
the same funds transferred over. The only difference was we have a different stable value fund. We were with the Galliard stable value. Now we're with the Putnam stable value. Other than that, all of the funds are exactly the same. They mapped over.
Okay. Thank you.
Thanks, Tony.
No problem.
I meant to mention that, and thanks for pointing that out. This is one change as a result of the transition. We had an opportunity to utilize a stable value fund that provided a more enhanced interest rate or crediting rate to participants. So we were able to switch out the Galliard fund with the Putnam stable value fund. So if you do hold that fund, that transition was made for you. There's nothing that you need to do, but you'll see a different name in there for that stable value.
And Emery, go ahead. I was going to say, Emery, with your sorry, I'm over talking. Go ahead, Poe.
No, just like great. Thank you.
So Emery, with your question, the Schwab brokerage option is available, but you can only purchase mutual funds within that. That's keeping in alignment with the overall investment strategy within the plan itself, sticking with mutual funds.
Okay, I suspected there was a restriction like that. Yep.
Yep, that's exactly it. So you would not be able to do any of the more planned out options like you were suggesting there. And Ted, I think that's it for the questions at the moment.
Okay, perfect. Thanks, Tony. Okay, we covered that. All right, now a little bit of a deeper dive on the plan fees. What are they? That administrative line that we pointed out, the cost to you all across the plan. Again, this hits every this is charged broadly across the plan on a pro rata basis. It's 0.08%. What does that cover? That's all non-investment related fees for the plan. So again, as I've mentioned before, there's a lot of services that are involved in bringing a retirement account to a plan. There's the record keeping component. That's your Empower piece. There's an entire legal structure that's applied to retirement plans and fiduciary structure. So there's a lot of contracts and those sorts of things that are involved, consulting, auditing. So all of that, everything that's involved in running your plan and doing it in a way that's efficient is involved in this 0.08%. This is a fee that you'll note from time to time is the committee, we review it every year. And since we began working with the city 5 years ago, that annual fee was 0.12%. And as we've continued, the plans continue to grow, the city's been able to negotiate more favorable terms. That annual fee is reduced. So that's something that you'll probably note going forward is that's liable to change, likely reduce and again become less impactful over time. But that's what that cost is. So again, if you see that value, that negative deduction on your statement, that's what that is. It's that 0.08%. The investment fees have a bit of a different range. And again, these are the individual investments that you hold. Each of those investment managers have their own fee structure. We utilize the lowest cost version available of each of the investment options. That can get into a whole different detailed discussion on fees, which I'm happy to have. But just know that the city is negotiating on your behalf to try to get the most favorable investment fees available in the market. The range for those of those fees is between 0.012% and 0.97%. So almost nothing to almost 1%. And the reason why you have one investment option being more expensive than another is it might be a smaller fund. They have more of an active approach. Their research process costs more. Their trading operations look a little bit different. There might be different reasons why different funds have different structures. And that's just has always been a component of investment options. But the return that you receive is net of the investment fee. So for instance, if your overall blended expense ratio of investment fees was 0.50%, let's just say, and the return for your overall portfolio that year was 10% gross of fees, you would see your return of 9.50%, right? So you wouldn't necessarily know that there was a cost, but they're built into that return structure that you would realize. Questions on investment fees? Okay, I mentioned the managed accounts. For those individuals that hold managed accounts, or again, the term with Empower is called My Total Retirement. The cost of those, it's a progressive structure, is 0.15% up to 0.45%. I'm sorry, it's regressive, not progressive, and I'll explain that in a bit here. But it really depends on your account size, but it's again, that's a charge that each participant that has this service is going to pay. That's not a charge across the plan. What you're paying for is for a third-party service to build an allocation for your portfolio utilizing those do-it-yourself options. That's what you're paying for. There's a questionnaire, as I'd mentioned before. You're going to input a lot of data points. It's important to note that one of the primary items used in the calculation and the optimization of your portfolio, what sort of mix, is time horizon. And this is really any investment management from a big pension plan all the way down to an individual investment account. Time horizon is one of the most important considerations for any allocation. So, I bring that up because you do have those target date funds, and if you're in a point of your life where you have some time until you retire, time horizon is probably the biggest consideration. When you're closer to retirement, a couple of years, time horizon, you're probably more concerned because you have a short time horizon about volatility in the marketplace, and you want to be more conservative. If you're farther away from retirement, you're not so concerned about the ups and downs in the market. You're okay being exposed to volatility and sort of, what we see in the S&P 500 and the news reported every day. That doesn't impact you as much because you're still 30 years or 20 years or whatever away from retirement. So again, that time piece is the biggest consideration. With the managed accounts, there's also the target date funds that you can utilize. To provide a little bit more detail on the impact, if you do have the My Total Retirement versus the target date funds, this is what your cost would be. So for an individual that has up to $100,000 in their retirement account, the annual fee is 0.45%. So that's applied to the entire amount up to $100,000. So if you have an account that's $100,000, of course, the cost to you for that service is $450 annually. For any dollar above that $100,000, so 100, this looks like kind of like an IRS tax table. From 100 to 250, the fee on that is 0.35%. So the blended total cost is $975. And you can see there's another tranche from 250 to 400. The fee reduces a little bit. And then anything over $400,000, your any dollar beyond that $400,000 amount is 0.15%. So if you're at that $400,000 mark and you're using the My Total Retirement, your cost just for the My Total Retirement, not for your investment expenses, is $1,350. So coming down here, I just kind of reran some numbers just to say, what if your account was at, sort of different levels? What's your blended rate from a percentage standpoint and from a dollar standpoint? So if you have an account that's, $350,000, your cost is 0.35%, and it's $1,200 more or less. So you can kind of see a range of costs there. Keep in mind that the underlying investment expense ratios, the average of that entire lineup that we looked at before is 0.32%. So that would be in addition to. Contrast that with target date funds, kind of a similar exercise. You're not using the My Total Retirement service. You're just using one of the target date funds, which all have the same fee structure. The cost there for the investment piece is, you can tell, as you can compare, it's considerably less. So a pretty big difference there between the two. So this isn't, I'm from a direction standpoint, I would just say, if you're gonna use the My Total Retirement service, make sure it's something that you really need and that's gonna benefit you. Otherwise, those target date funds are gonna accomplish a similar goal, and your headwind of costs is gonna be minimized significantly. And in a market that, on average, for just looking at broad returns in the stock market, gives us about anywhere from 7 to 9% on average per year. If you take out 0.45% of that 7 or 8%, that's a pretty significant headwind and a pretty big cost over a longer period of time. So not saying don't do it or do it. I'm just saying be aware and understand what the cost is, and just make sure that benefit, that there is going to be a benefit to you for that. I'll pause for any questions or comments that folks might have. You seen anything, Tony?
Nope. There was one question put in the chat here, and someone just asked about canceling the managed account. And you should be able to do that on the website, or reach out to the Empower Service Center, and they would be able to help you.
I'm going to just mention too, and I believe this is the case with Empower. It's different from different record keepers. I think it's like canceling your any sort of app subscription, where they take you through about 15 steps to ensure that you want to cancel. Are you sure you want to cancel? Are you sure you want to do this? So be persistent if you're going to cancel that particular service. And I just encourage you, there is a light at the end of the tunnel there. We did
arrange that, I believe, through the end of March for the managed accounts. There is a hold on ongoing fees. So then beginning after March 31, anyone who currently has a managed account would be in the fee structure. That's
right. Thanks for the reminder.
Yep, Donald. No, that was exactly the thing. As we'd put out a couple of notices when we sent out our transition paperwork, letting people know that, this is a thing, because we know a lot of people don't look at their accounts. They make it, they make an election at one point, and you set it and forget it. So this was an opportunity for people to review what options they had and if they wanted to make a change or not.
And I'll just add on to a bit of what Tony said. We do see from time to time where somebody enters into a managed account arrangement, not knowing that they did, or really not knowing what it is. And just, we just want individuals to be aware. If it's something you want to choose, just understand and know the impact. Again, not saying it's not something you should do, but it would, wouldn't want you to necessarily just happenstance stumble into that. Okay, I'm going to provide a couple slides on the Vanguard target date funds, just as general education, so you understand what they are. We talked a bit about them, and I'd mentioned that they're dynamic over time. This is a snapshot at 3 of the vintages that I'd shown earlier. One's the most conservative version. One is a vintage that will be hitting that in a couple of years here, and the other is a little bit farther out. So just looking at the color-coded sort of coordinated pie charts here, the teal and dark teal, or sea foam, or whatever color those are US stocks and foreign stocks. And when you look at the income, again, that's assuming that you've retired or at retirement, or you just really want to minimize the ups and downs in your portfolio. This is the investment that you would utilize. Again, knowing or with the approach that you still want diversification, but you want to kind of minimize the impact of stocks in the stock market. So you can see that that teal or green is pretty minimized in this portfolio. It's about 30%, 31, 32% of the portfolio. Contrast that with the 2045. So this is somebody that has about 20 years until they retire. As I'd mentioned before, that individual, you're not going to use these funds for another 20 years. And even if you start to use them in 20 years, you're not going to use all of those dollars in year one, right? So a lot of those retirement funds are not only 20-year dollars, but they're 25 and 30 and 40-year dollars, because in theory, you set up a stream of income when you retire, and then you start to access at that time. So there's a lot more stocks, right? And why do you accept that? You accept that volatility and that uncertainty today for the potential for greater returns over a longer period of time. And we've seen that in stocks, right? Stocks versus bonds have provided a much greater return over a longer period of time. And they fit differently into a portfolio. So for that long-term investor, really concerned about beating inflation, building up their account to a suitable amount, they're not concerned about volatility and they accept the risk. For the person that's a little bit closer to retirement, a little bit closer to even, still want to grow their account, still have a bit of a time frame, but want to preserve a component of it as well. So these funds will change in their dynamic over time. This is what we call the glide path, and essentially the progression of these funds over time. So here we are. So this right here on the very far left, where you see this 20, this would be similar to this 2045 fund, right? We're about 20 years out from the vintage date, in this case, 2045. And today, about 90% of it or so are invested in stocks, that dark teal and that light teal green. The bond portion of it, or the little bit more conservative portion of it, is represented by the yellow. And really it remains in this allocation until, I'm sorry, I had my numbers wrong. This is 45 years out. So that 2045 is probably more somewhere right of that 40 mark. So when this fund is about 25 years out from that vintage of whenever, the 2045, whatever it may be, it starts its path of moving a little bit more conservative. So anything prior to 25 30, 35, 40, the allocation looks similar. So think about that 2070 fund. The allocation looks similar to the 2060 fund. So as it starts its glide path, the mix of stocks, or again, kind of the growth engine with more uncertainty, and bonds starts to change over time, and it works its way all the way down till it hits its vintage, where it's about 50-50 mix between stocks and bonds. Another notable item is that they've started to include what are called TIPS, or Treasury Inflation Protected Securities. These are bonds that are tied to inflation, and they use that as another diversifier to address inflation throughout retirement, longevity, and whatnot. These funds continue to migrate beyond their vintage date. So the 2025 fund, we're 1 year beyond that. And for the next 6 years, it will continue to migrate down to a 30% stock, 70% bond allocation. The exact same allocation as this income fund on the left-hand side here. And Vanguard will retire that fund and roll all of those dollars into the income fund. So there's a progression that's set up. If you don't do anything and you stay with the city for a really long time and you hold one of those target date funds, you're going to have that dynamic portfolio. It's going to change its mix of assets over time, and then it will ultimately migrate into that target retirement income fund, which again you can hold. Important to note that you can change out of these investments at any time. It's not a maturity date. It's just more of a naming convention that just lets us know what's the target that they're investing the funds for. But as far as changing or transitioning, you can do that as much as you want. There's no fees or costs or tax implications for that. That's how the target date funds work. Again, kind of a bigger picture. Is there any questions or more detail that'd be helpful on this, or any other items?
Sorry, could you repeat the last question, the last answer? You said something about you can withdraw with no fee. I mean, I missed that part. Sorry.
What was the question,
about
Tony?
what? Yeah, it's something about that. He's saying something about you can draw or not put more fund on my, unless I misunderstood that, with no fee. That the last sentence, or the last I guess what Ted said, the last one about no fee. You can do whatever you want with the target date, or unless I'm missing something.
Let me say, so Ted, let me address this question. So this is Michelle L., Deferred Compensation Manager. So our Empower is our record keeper. So you can change your investments whenever you want. There isn't a fee for changing investments. So if you were in, target date fund 2040 and you want to be target date fund 2045, you can change that at any time. There's no fee to do the change. The fees are associated with the fund and what the plan charges as a fee. So you can change your investment allocation for future contributions at any time and what exists currently. If you're doing that, there isn't a fee for that.
Got it. Thank you.
Yeah, and maybe I should have clarified there. For the ongoing cost of holding an investment, every investment has a cost. It's an annualized fee that's just going to apply as long as you hold that fund. But if you change from one fund to the next, you can do that as freely as you want, and there's no transaction cost for that. So your investment lineup is very fluid, right? You can change, and you're not stuck in any investment. There's no term that you have to stay in any investment. It's really flexible for you. It's just a matter of what's most appropriate for you and building that in.
I also wanted to broadly comment that the default investment for an employee who enrolls in the plan and just doesn't make an election, you don't want to you're like, you don't want to make an election, the committee has decided the target date funds closest to when you're age 65 is the default investment. So that is the vast majority, like that's the investment. If you're not going to elect anything, it's the target date fund closest to age 65. I'm aware that people retire much earlier. So if you want to change it, feel free to change it, but that is the default investment for the plan.
And then if we don't want to do our own, just like the target day can be 65, target age can be 65. But as the people continue to work past 65, do we have the contact and power to ramp it on an investment fund, or just continue doing whatever the fund is currently at? Does that make sense? So
Ted,
let me
you're
rephrase this
muted.
way.
Ted, you're muted.
Thanks. What I said was great. Just couldn't hear it. No, I think if I understand what you're asking, yeah, you could either change it yourself through the website, or you could call Empower and say, hey, I'd like to move to a different type, a more aggressive investment, or 2070 or 2030 or whatever. If you're past, if that, let's say, the 2025 is the investment option that you have, and we've of course already hit that, you're just going to remain invested in that fund until that fund is retired by Vanguard, and then your assets are automatically going to go to this retirement income trust. If you don't want that to happen, then yeah, just change it to invest in one of these other funds, 2030 or 2050 or something. Does that answer your question, Poe?
Yes, thank you.
Yeah.
I have a question. Once
Go
it's
for it.
past, like, for example, you just mentioned, if it's a target Vanguard for 2025 and we've already passed 2025,
Yep.
how long does it remain in Vanguard fund? At what point do they decide, excuse me, to put it into another retirement income trust?
It will always remain a Vanguard fund.
Okay.
But it will, again, it's gonna continue to, that version, that Vanguard fund that you have, let's say the 2025 fund, at 2025, that fund's allocation is 50% stocks, 50% bonds. For 7 more years until 2032, that fund is going to continue to be dynamic and change to become more conservative. And once it hits its sort of landing place where it flattens out here, you can see on the graph that I have, Vanguard is going to take the assets that are in that 2025 fund. They're going to terminate that fund, and they're going to move all of the assets into a Vanguard Target Retirement Income Fund, which has this same exact allocation. So they all sort of transition. The Target Retirement Income Fund is where target date funds go to die. That is a Vanguard fund. So you'll always have Vanguard. It'll just be, it won't have a vintage on there. It'll just be that income fund. Does that explain it, Mandana?
It does. That I was looking for that time frame, the 7 years. But then my next question is, if the money is not withdrawn within that 7 years, for example, then you said is going to go to another income fund. Is that what's going to happen, basically, to whatever the choice is for Vanguard?
Yeah,
Like
it will go. It will go to. Do you see the slide I have up right now?
Okay. Yeah.
It'll go to that top fund on this table. It's just the most conservative version of these funds. That's what it will transition into.
Okay. All right. Thank you.
Yeah. Yeah, I guess maybe just thinking about it's not going to go to any other type of investment. It won't move out of this target retirement income, these suite of funds. It's just kind of going to the final stage of the progression of the how those funds are invested. That was the last slide that I had to present to you all. Again, this is really meant to just sort of hit a couple topics, refresh you of some of the items that are available in the plan. And if you know you have more, would like more detail or sort of how does this apply to you individually? Empower has resources, someone you can connect with individually. I'm happy to answer any questions that you might have specifically about investments or whatnot as well. But I would reach out to Tony and Michelle if you would want to try to schedule something with an Empower education individual, and they'll certainly be able to sort of work with you on how do you apply this investment lineup to yourself.
Yeah, I just want to add that we have, Empower is our record keeper. And if you have questions, we do have an on-site rep, Sean Howard, in the Seattle Municipal Tower. So if you want to enroll, make changes to your account, please reach out to Sean, or you can call the customer service number for Empower. And if you have any questions or feedback for the committee, so we have a governing committee for the plan, maybe you want investment changes or fund recommendations that you should add to the core lineup, feel free to communicate that to my team. So our emails deferredcompquestions@seattle.gov.
Are there any other questions or things folks might have? I know we have a few more minutes here, so I want to give time, even outside of what we've discussed today.
And I did post earlier in the chat to keep an eye out that we have a Empower is hosting a website and enrollment and overview next week on Thursday at lunch as well. So if that interests you, keep an eye. We send our notices out through the benefits channel. So they email out to the departments email out to the individual employees or host them. So you should be able to get the link for that and add it to your calendar for next week, Thursday at noon.
Kirk, you got your hand up?
Yeah. I was just curious. I know they've done that in the past. They had a somebody come down to the city, and they could set up like little appointments to show them how